By the way, I like the one about how to invest in real estate without fixing the toilets or having to fix the toilet. I also like the one about how to make your kids or how to help your kids be better investors than we were. My son is a much better investor than I was, certainly. So hopefully he's going to pass it on to his own son, my grandson or grandsons, as it were. We have the chat box open and we already have a few questions, so I'll go right to it. And if you'll bear with me for a minute, I have to go back up the list. The first one was, would TradeX be considered a commission fees or commission-based? You talked at the beginning of your session. The first question, I believe, was, are you using a commission or a fee-based advisor or someone who's just not getting any fees? So what about TradeX?
Well, TradeX is a bit of a hybrid in that it started off as a mutual fund company and then I believe has moved to become a fee-based advisor. So I think they still have the mutual fund part of things. But as I say, I believe now that they will give you fee-based advice, and I believe that they will act as a fiduciary also, and that they don't limit themselves to what they can invest in. So they can help you invest in ETFs, index funds, and I don't know if they do individual stocks. So in answer to the question, they are not now, to my understanding, commission-based, but they are a fee-based.
That's my understanding as well, Michael. The next question is, how would you know if your advisor has fiduciary responsibilities?
Well, the easiest way is to ask him to give you a written statement showing that he does. I know that some of the companies, PWL is one, states right on their website that we are a fiduciary. We take a fiduciary responsibility, and they will give you a written document stating that they are. Failing that, you can ask for a written contract whereby the advisor says that I will act as a fiduciary for you and I will act only in your best interests. I guess the other side of that is that if somebody will not give you that, then you probably should not be dealing with that person, because you have to ask yourself, well, why would somebody who I'm paying a fee to not act in my best interests? And Alain, you can comment perhaps a bit on this from the accounting profession point of view, because I believe the accounting profession has a built-in, for example, if you're a CPA, a built-in fiduciary responsibility.
Yes, we do. And there's also a code of ethics that we have to follow. And the penalties are quite severe if you're found to be not carrying out those responsibilities properly.
Yeah.
Financial advisors generally, there are, to my knowledge, there are no or very light penalties. And if they don't have a fiduciary responsibility, there are virtually no penalties except the recourse to courts.
Yeah, which, well, actually, it's not even recourse to courts, because when you sign up with a lot of these advisors, you automatically give away your right to take them to court, and they go to some sort of adjudication, which has been shown over time not to be particularly sympathetic to investors.
Yeah, yes, a form of tribunal that doesn't help much. The next question is, are fees charged on GICs?
Well, it depends how you hold the GIC. If you buy the GIC directly from a bank or a broker, then there's no fee on the GIC. What you see is what you get. And in fact, essentially the fee is built into the interest rate that you get or don't get. But if you are dealing through a fee-based advisor and they're getting GICs on your behalf in the account they're managing, then yeah, they're charging you fees on those GICs. One acquaintance I know, we had this discussion recently, that he's got in one of his accounts GICs, and he is paying an advisor a fee. So he's paying a fee on those GICs. And as I mentioned earlier, if you're earning 1.7% on a 5-year GIC and you're paying 1% per year, and then you pay tax when you take it out of the RIF, that don't leave a hell of a lot.
No, it doesn't. I just want to remind everyone that if you have questions, you can type them in the chat box, and we will keep going through them. The next one here is a bit long, so I'll read it. I have a GIC at a bank. They won't provide statements. I need to get out of that. Can I do this other than on an anniversary date? And can I at least move to another bank where I can reinvest somewhere else?
Well, the issue with GICs is that unless it is a specifically cashable GIC, and most are not, then you cannot cash them. It's the anniversary date that you get your money. It's like a fixed contract, and you are stuck to that contract. So all you can really do is wait for the anniversary to come up, for the GIC to mature, and at that point you can take your money and do with it whatever you want. But to my understanding, Alain, you cannot even cash a GIC early and even pay a penalty. I think you're simply stuck with the period of time that you signed up for. So if you signed up for 5 years, you got to wait 5 years.
Yeah, that's my understanding as well. If it's a non-cashable GICs, you basically have to wait until it matures. As far as the statements are concerned, that may not be unusual.
Yeah, the non-cashables pay, or the cashable GICs pay so little. And my wife recently renewed some, and I think the interest rate is 0.3.
Yeah, which is about the same or maybe slightly better than in a savings account. As far as the statement question, the question of providing statements is concerned, usually when you buy a GIC, you're given an option of reinvesting the interests as it comes due every year or every period, or getting the interest deposited into a bank account. I'm not sure that I have ever seen a GIC that provided quarterly or yearly statements.
No, generally you get a letter a few months before it's going to mature saying what do you want to do with it, or it will automatically roll over.
Yeah, I know that I have some GICs for money that I think I'll be needing in the next few months, although with not traveling, that might not be the case, but I don't get any statements, and I've never gotten statements from GICs except, as Michael mentioned, close to the maturity date, you get a letter, or in my case, it's an email because I do all of these transactions electronically. But I also set up what is going to happen with the interest in the interim. And my preference is to reinvest the interest when it's a GIC that's longer than a year. We seem to have run out of questions right now. So if you have questions, please type them in, and we'll answer them. Otherwise, we will close it off. And Michael, while we're waiting to see if any more questions come through, you've talked about some of the seminars that you're proposing for next year. So just to remind everyone who's on the Zoom webinar today, that we will be continuing those webinar in the new year. You will be getting more information about what webinar and the dates and everything in the next few weeks as we send out our newsletter. So make sure that you read the newsletters. The information will be in there, as well as information on how to register. And we have a very interesting program that we're working on developing right now. So be sure to stay tuned and to look at your emails, and don't just delete them from your mailbox, as I did recently, deleted an email that I wanted to keep. So I don't see any more questions coming in, Michael. So we'll close it off for today. Thank you very much again, Michael, for this excellent webinar. And for Michael and everyone else on the call, please keep safe. And even with the snow today, if you don't have to go out, don't. But if you have to go out, drive safely. Thank you very much, everyone.
Alain, I just wanted to note, this is Sarah, that there are a few more questions in the chat. I'm not sure, maybe there's a delay.
Okay, sorry. It seems to be slow coming in on my iPad. Thank you, Sarah, for catching that one.
No problem.
Yes, okay, I see them coming in now. So are the fees paid to a financial advisor tax deductible?
The fees paid to a financial advisor are tax deductible, yes. Fees that are embedded in a mutual fund are not. And the reason is that they have already been subtracted before you get the value of the mutual fund. But yes, any fees paid for specific advice on buying investments are fully deductible against your investment income. But I have to underline that there has to be investment income. So what is investment income? Investment income is interest, dividends, that sort of thing. Believe it or not, I don't think it's capital gains. But anyway, fees for an advisor are fully tax deductible against investment income.
Capital gains would happen when you divest of the investment. So if there is capital gains, that yes, you will be taxed on that. And you can use capital losses as well from prior year to do the offset against taxes. We have a question here. Well, it's more a comment than a question, I guess, to include the slides in the material that we send out. So again, just to remind everyone that you'll be receiving an email telling you where to get the slides. They will be posted on our association website. And the question also says, can you include the correct answers to the poll questions? So that one, Michael, I'll let you handle it because I'm not sure that there are correct answers.
That's right. I think only the last one had correct answers, and the answer was, if I recall, 2 and 3.
Yes. Also include the definitions of types of advisors. So that we can put on our website as well. One question here, what is the difference between a mutual fund and an ETF?
Okay, that's a good question. Basically, an ETF, exchange traded fund, is a type of mutual fund, but it is sold directly to you like a stock, and it's listed on stock markets. And it has a number of advantages, but advantage number one, because it's sold directly to you rather than through, say, a financial advisor, there's no trailing commission. So that immediately reduces the fees by about half. The second thing is that the administrative burden on the issuer is much less on an ETF than it is on a mutual fund. So their administrative and marketing costs are much less. And that again reduces the fee. So typically, an exchange traded fund that tracks, say, an index, let's say one that tracks the Toronto Stock Exchange, has a fee these days of around 0.05%. So 0.05%, where a mutual fund that does the same thing has a fee typically of around 1%. That's an index tracking fund. If you compare an actively managed ETF, so for example, I know of one that is an actively managed real estate investment trust ETF. The fee on it is around 0.8, and you can buy exactly the same thing as a mutual fund, and the fee is 1.8. So to sum up, the real difference between an ETF and a mutual fund is how it is sold, bought, and the fees. Other than that, they can be exactly the same.
All right. Next one is, to my knowledge, only the designation called portfolio manager has fiduciary responsibility. Is the CFP newly required to have that responsibility?
That's correct. It's a relatively new requirement of the Financial Planning Institute of Canada that all of its CFP members will have a fiduciary responsibility. That's, I think, within the last 12 months. So that's a major
Yes.
breakthrough and is going to set a standard, I hope, for the entire country. By the way, in the United States, they're having the same sort of debate, but in the United States, they have a regulation that says that anybody who is providing advice on retirement accounts, sort of equivalent to an RSP, must act in a fiduciary manner. That's for everybody dealing with, the equivalent of RSPs in the United States. That is not the case in Canada.
Yes. Next question is, can you comment on how the Canadian and provincial debt may affect investment returns in Canada and the Canadian dollar?
No, I'll leave that up to you, Alain.
Well, I'm not an economist. I'm just an accountant.
I'm not an economist.
But I would defy anyone to be able to say what is going to happen in the next few months, certainly not in the next few years.
Yeah. I think the main thing that question underlines is the stage 3 of investing, where you have to know what you don't know. And I know I don't know that. So
yes,
when you build your portfolio, when you deal with your advisor, ask them that question. How do I deal with uncertainty? Because as I've said in the past, the one thing we can be certain of is uncertainty. And so you have to build a very resilient portfolio that can do okay in both good times and bad. And I've talked about this in the past, but there are certain investments that, for example, people say, well, why would I invest in bonds at this point? They pay nothing. Well, yeah, but paying nothing may be better than losing 20 or 30%. So nothing may actually be good. The same way gold, which has been beaten up lately, gold, we know, acts in the opposite way of the stock market. So the stock market's been good recently, gold's not done well. But when the stock market tanks, gold tends over time to do well. So these should all be things that form part of an investment portfolio. And that's why buying one of these all-in-one ETFs like VBAL, which includes all this stuff, is potentially a good solution for people.
Yeah, and that underlines the necessity of having a well-diversified portfolio, and also understanding that return is related to risk. So when you see high returns, that generally means that the risk is also higher. And over time, these things tend to average out. So if you are looking at a 15-year perspective, your chances of having a portfolio that will even out over time is much better than if you're looking at a 5-year or 2 years. That's my lesson in accounting and risk for today. Is there a difference between the bank wealth groups and the independent, like Raymond James or Hollis Wealth, or many others as well?
Well, the only difference, I think, is that the independents are more independent in terms of what they select as investments. I don't know if this is the case, and I really wouldn't want to say so, but it might be that those that are allied with the big bank brokerages get certain incentives for selling that bank's products. Although I have to say, I used to have an account with one of the big bank brokerages, and I never found that they were trying to flog their particular products. So I'm not sure that there would be any difference.
Yeah, that's been my experience as well, dealing with the wealth management branch of one of the big banks, which is independent from the banking part of the bank. They don't try to sell a particular product, but they look, and they're very good at looking at different things. When I ask them, what about this particular investment here? They've been very good at providing answers to those questions. Okay, well, let's see here. Someone asking about including the Q&As briefly covered. So I think Sarah will, if we have the audio, we'll be posting the audio. Sarah, are you able to answer that?
Yes, we will be posting the audio after.
So the Q&As will be posted on the website. Next question is, what are items to be concerned with researching transfer of account with a wealth management firm with your own mutual funds and portfolios in both registered and non-registered accounts to an independent advisor, fee-based advisor?
Yeah, that's a good question, and I'm glad it was raised. Most times the sending institution will charge a fee, not a huge fee, but typically $150 per account to make the transfer. I have found that most receiving institutions where you're setting up a new account will be happy to cover that fee just for asking. It's not a huge amount of money. In my case, I transferred a bunch of accounts from one big bank online brokerage to another. And when I set up the accounts with the new firm, I asked for a commitment in writing that they would cover all fees, and they did.
Yeah, that's been my experience as well when I've transferred from one institution or one provider to a different one. Some of them have actually offered to cover the fees, and others, when I asked if they were going to cover it, have agreed to cover them. Does CFP designation apply in Quebec as well? Are there differences in designations, responsibilities? Do advisors need different certifications to have clients in other provinces? For example, Quebec versus Ontario.
Yeah. Well, that's really two questions.
Yes.
The Financial Planning Institute is a Canadian-wide operation. And so you can have CFPs in all the provinces. Having said that, as I mentioned earlier, Quebec does have much more stringent regulation than Ontario does on who can call themselves a financial planner or advisor. I'm not up to speed with the details of their regulations. I just know that they are there, and I believe that they are quite seriously enforced in Quebec. And as I mentioned, the reason why, you may recall, Alain, there was a situation about 10 years ago where some guy was operating a financial advisory service that really wasn't. And he embezzled millions of dollars that he took in. He was sort of Canada's mini Bernie Madoff, you know, where they created these fictional accounts. People were making all sorts of money, supposedly. And basically, he was just taking the money and spending it.
Yes, you had a very nice cottage in the Laurentians. I remember that very well.
Yeah, and I think after that fiasco, Quebec brought in really good regulation, and it's a shame that it has not been brought in other provinces, quite frankly.
Yeah, there's been pressures to tighten the regulations, but so far it's moving very slowly.
Yeah, and you know who the main opponent is to it? It's the investment management companies.
Yes, of course.
Yeah, which I find hard to, I mean, I don't know how they justify that.
The next question is, I have mature GICs. What are my choices on investing them outside of GICs?
Well, anything. If you've got a mature GIC, basically it's cash. You can take that money and move it anywhere you want and do anything that you want with it. Yeah,
and that is probably a case where asker of the question should talk to someone who's a person who can provide good advice, a professional. Where, as you said in your presentation, Michael, it's worth to pay for good advice, because in the long run, you're going to do much better.
Yeah, indeed.
Question here is, how do you find an advisor or advisor that focuses on issues directly related to retirees?
Well, the only way, frankly, is to go online, Google for fee-based financial planners, and call them up or go see them and ask. And there's no short way of doing it, unfortunately. You got to go talk to them and essentially say the question, what do you know about spending investment money in a tax efficient manner that is going to allow me to have this money generated over whatever number of years you need. But as I mentioned earlier, the vast majority of financial planners and advisors are more oriented towards wealth accumulation than decumulation. So it takes some work to find them. But as I also mentioned, one of the simple ways, that website I mentioned, but you can just go online using Google and Google a number of things like fee-based investment planners, fee-based financial planners in Ottawa, and you'll come up with a number of names of people that you can then talk to.
Yeah, the question or the conundrum between accumulation and decumulation is one that you've talked about in other seminars as well. And a lot of the financial advisors are focused on accumulation because that's what they're used to do. Here's a question about having cashed some equities at recent highs and waiting for a fall in the market. What is the best place to just hang on to cash? Sounds like someone who's trying to time the market here.
Yeah, well, where's the best place to keep cash? I don't know. My approach is just to spend it. I've decided that with COVID, since I can't travel anywhere, we need better seats to sit on in the house. So I just went and spent $10,000 on new furniture. Anyway, there's no good place to keep cash right now. The theme in the investment community is cash is trash. So, you can put it in a laughingly called high interest savings account through any of the banks or brokers. And I think I looked the other day and I think I was making 0.3 or 0.4% on my cash. It was so bad, I almost didn't bother even putting it in the thing.
Yeah, the return on savings account right now or short-term GICs are so low that you actually, after you pay the taxes, and remember that interest is taxed at a higher rate than dividends and capital gains. After you pay the taxes, your returns are virtually nothing. So it might be a question of not waiting for the market to fall, but looking at how you can build a portfolio or reinvest those funds over a period of time rather than going all in at one point in time. That would certainly be my approach. Another general or great learning session here. Thank you, Michael, and everyone else. So that's a comment. Thank you very much for that. Fee-based advice, does the advisor still monitor your portfolio or is it a one-time only issue?
Well, another good question, and that's a choice. You can have a fee-based advisor that manages your portfolio on an ongoing basis, for which you pay, a fee of perhaps 1% a year. By the way, if you're paying more than 1% per year, you should start to question things and perhaps look at other advisors and see what they would charge. I was talking to one person, one of the seminars that we gave at the office a year or two ago, and he disclosed to me that he had several $1 million invested and he was paying over 2% fees. And I had to say to him very candidly, you're being ripped off. You should not be paying anywhere more than, you should not even be paying 1% with that size of a portfolio. But as I mentioned, you can also go to a financial advisor and just get basic advice on how to set up a portfolio that they'll charge a fixed amount. Sometimes it's a few $1,000s, sometimes it's by the hour, and they'll give you a plan. In that case, it's up to you to monitor the plan and manage it.
Okay. We have a couple of questions that are very similar here, so I'll have them both, read them both at the same time. Can I move a GIC to another bank only on maturity? Can advisor charge a fee for transferring a GIC to another bank?
If the GIC is within a investment account, you can transfer it as is, as long as it's not cashed, because you can, it doesn't matter which account you hold the GIC in. If, however, you hold the GIC, you bought it directly, say through a bank branch or something, then you cannot transfer it. It has to be in an investment account. And can they charge you for doing it? Well, as mentioned, typically there will be a charge if you're transferring the contents of one investment account to another institution. But the receiving institution usually will cover the costs of the transfer.
Okay. Yes, a couple of questions here dealing with tax deductibility for management fees or fees paid to an independent advisor. Are they tax deductible?
The answer is yes. As long as it's advice on buying investments, investing, then Revenue Canada says, yes, it is a tax deduction against investment income. What is not a tax deduction are things like investment letters or subscriptions to the Globe and Mail for their report on business, things like that. It has to be directly related to buying and selling of investments, and then it is tax deductible.
Okay. I'm just going through here comments. Yes. Given that you want to engage a CFP, how do you focus your search and how do you evaluate?
Well, again, use that website that I gave you as one way to find a list. And the other way is just to do a Google search of fee-based investment advisors or certified financial planners. You can also contact the Financial Planning Institute of Canada, and they will give you a list of CFP members in this area. So there's a number of ways to do it. And of course, the other way is ask people who who may have a financial planner or advisor that they're happy with.
And use the questions that you mentioned in the presentation when you're talking to these prospective financial advisors.
Yeah, I can assure you that anybody in the investment advisory business who is a CFP will boldly print those letters after their name.
Yes, they will. Here's someone asking, who can provide the best tax advice? So I'll wait to hear what you have to say on that, Michael.
I'll say accountants.
If you want tax advice, don't go to your brother-in-law or your cousin or your neighbor. Talk to a professional who's a tax specialist, because not all accountants are tax specialists. But the best advice will come from a specialist in the area, and it's worth paying for the fees. And I'm not saying that because I'm a CPA, because that's not my specialty, it's not taxes, although I have done quite a bit of it for myself and a few people. But the fee that they charge, generally, if you have complex situations, the fee that they charge is worth paying for.
Yeah, I dealt with a tax accountant when we were doing my dad's estate. And the money that he saved us in, you know, explaining how to do certain things or suggesting, you know, certain things that we do. And, you know, the tax code is, I don't know, like, what is it, 10,000 pages, I think, Alain? I mean, it's just, it's ludicrous.
I don't, yeah, I don't know how many pages it is now, but just a small anecdote. In the 70s, when I was doing my accounting designation, studying for the exams, the tax code was a small booklet, maybe an inch thick. A few years ago, because as a CPA, we have to we have to keep our certifications up to date and do some professional education. I decided to take another tax course because I hadn't taken one in a long time. I got a binder, a 5-inch binder full of material, and 3 other binders that had tax laws and tax material from CRA about the decisions that they had made. So it went from about a 2-inch, an inch and a half, 2-inch booklet to something that was almost the size of the height of my desk. It's very complex, and there are so many situations where you have to know not only what is the regulation, but what is in the law, and it's worth paying for. If you have a complex situation, it's worth paying for a specialist. Okay, are the fees paid to a commission only advisor tax deductible? I think that we've talked about that already.
Yeah, the answer is yes.
My advisor at a big bank investment house has a CFP. Does this mean there's no potential for conflict of interest?
Probably not, but I would ask to see their fiduciary statement in writing. And then you can be sure that there's a lot less. I mean, look, the fact is that there's always some potential for conflict of interest, even when people are acting in a fiduciary responsibility. Nothing eliminates it. I mean, there have been stories of certainly, you know, lawyers who have bilked their clients despite having a fiduciary responsibility. But having said that, a CFP designation along with a written fiduciary statement is a pretty good way of eliminating 99% of potential conflict.
Yes. One question here is, would you suggest taking the option of leaving 25% of the mandatory RRIF withdrawal that is available this year? I believe that's something that is new under the protection for investors because of the COVID.
Yeah, you know, that is a question that really depends on your individual situation and your tax rate, quite frankly. And it's impossible to answer generally. I think, as I say, it depends how much tax you're going to be paying on that withdrawal. What's the state of your investments? You know, in most cases, if people have just left their investments alone, they've recovered the vast majority, if not all, of the loss from earlier in the year. So I can't answer that. It's very individual.
Yeah, my answer would be exactly that as well. Without knowing any more about the specifics of the situation, you know, you have to look at what is your situation and what does it mean for you. There's not one answer for that. It's really, I think the best answer is it depends. Someone here asking about how does one find an advisor with tax knowledge for retirees? So we've talked about that a little bit. You've mentioned websites and whatnot, Michael. As far as tax knowledge, financial planners or financial advisors are generally not tax specialists.
True, but hopefully they'll have a basic understanding of, for example, the dividend tax credit and how it works. Although I was surprised year or two ago, I was at a meeting in Toronto, a lot of big bank senior people, vice presidents of this or that. And they asked me what I was doing there. And I said, well, I write this blog for investing for retirees. And they said, oh, really? I said, well, what's special about retirees? And I said, well, for example, the fact that in Ontario, if you've got a taxable income under $48,000, you effectively pay no tax on dividends. And so that should be a big part of your plan. None of them around the table even knew that. Not one of them.
Yes, which means that their tax was not one of the things that they were dealing with and concerned with on an ongoing basis.
Yeah.
Question here about, can you confirm that ETFs or dividend stocks can be held within an Rrsp or a Tfsa?
Yes.
Yes, yeah, that's a short answer, yes. Okay, is the CIM designation important for an advisor?
I don't know what a CIM designation is.
Neither do I. EQ Bank, which is, I believe, a online banking institution, pays 1.5% on a no-fee savings account. So that's not really a question. When you're dealing with online savings account through online banking, they will at times pay higher rates because their costs are supposedly less.
Yeah. You have to be a bit careful, though, that sometimes these are limited teaser rates and they're only good for a certain number of months. I have an acquaintance who sold their house and for a considerable amount of money. And you might be listening today, and he's been basically moving his money around from 3-month teaser rate accounts and tracking his money. But I think he's getting a little tired of it and wants to find a home for his house sale money.
Well, for what would be presumably a large amount of money, putting it in a savings account might not be the best place. Your friend will find out that he's going to pay quite a bit in taxes on that
Right.
interest.
Right.
Any thoughts on negative interest rate on savings?
Well, it's not so much on savings; it's on bonds. The fact is there's something like $15 trillion in government bonds around the world that are selling at effectively negative interest rates. And you have to ask yourself, why is this the case? And the answer is because they think it's going to get worse, and they're going to be more negative than they are now, in which case they actually make some money on the capital gain. So I don't know. I mean, $15 trillion in negative interest rates. What that says to me is that there's a lot of people who are extremely negative on the prospects for the economies in a lot of countries. Just as an aside, by the way, I was reading the other day, if you compare the rate on a 10-year US government bond to a 10-year Greek government bond, the 10-year US is about 1.6%, and the Greek is about 0.3%, which I think is an interesting comment, that a Greek bond is essentially deemed to be safer than a US government bond. But I won't try to figure that out.
I wouldn't try to figure that out either. I like Greece to go and visit, but I'm not sure that I would go further than that. Something here about what is motley fool considered?
Sorry, say that again.
Motley Fool, M-O-T-L-E-Y, Fool. I believe it's one of those online advice website.
Yeah, Motley Fool has been around, I guess about, 10, 12, 15 years. And basically it's an advisory service that you can pay a monthly fee for, and they give you suggestions as to what to invest in. By the way, the fees that you pay for that are not tax deductible because they're not directly related to buying and selling investments. You know, some people swear by it. They've done very well by it. I always wonder though about companies like that. If they really knew what they were doing, why would they tell others? I'd keep it to myself. And if I was really so sure about things, I'd keep it to myself and put every cent I owned into whatever investment it might be and not tell anyone. But there you go.
Yeah. I often think that the only people making money off of advice, investment book advice, especially, and other forms as well, the only one making money out of that is the ones writing the books. I've read several of them, and for one thing, you get contradictory information a lot of the time, and so you take it for what it's worth.
Yeah, and just on Motley Fool, I do read it occasionally because they seem to pop up a lot on web searches. And I recall last week in Motley Fool, 2 articles. One was very strong on buying Enbridge stock, and the other one was very strong on selling Enbridge stock, and that was out of the same company. So
yeah, contradictory advice.
I didn't find that all that helpful.
Yeah. Someone is asking about, can you explain what a Series F fund is? And sure. They have much lower MERs.
Right. A good question. In mutual funds, there's a number of different series, A, D, F, and maybe more. An A series charges a full management expense ratio. An F series charges about half. And the reason why is that F series are only sold through fee-based advisors. So the fee-based advisor is adding his fee, her fee on top of that, and charging you directly rather than getting it through the mutual fund. But they also have a lot of them have D series, and these have low MERs also because they're only available through discount online brokerages where nobody is paying a fee. You're not paying a fee to the brokerage, and because there's no advice being given, the mutual fund does not pay a trailing commission to the broker either. So yeah, good question, but that's the basic difference. It's the lack of trailing commissions.
Yeah, you're already paying a fee to an advisor, so the MER is less. Someone is asking here about your blog address. Can you talk about that, Michael?
Well, I shut the blog down, so there is no blog address anymore. And I shut it down simply because I found that I had run out of intelligent things to say. So I worked on the basis of, if you don't have anything intelligent to say, shut up.
That's good advice. Okay, this time it seems that we have run out of questions.
Okay.
So unless Sarah tells me that there are still some more that haven't come in on my iPad, again, I'll remind you that we will be continuing the webinar series in the new year, and thanking everyone for attending today. And thank you very much, Michael, for all of the time and effort that you put into these. It's greatly appreciated. Have a good day, everyone.
Great. Thank you again, Alain. Bye, everybody. Have a wonderful holiday season.